Ever feel like the financial markets are speaking a language you haven't quite mastered? Today, we're cracking the code on one of its more intriguing dialects. Derivatives. These aren't assets you can, touch, but they're powerful contracts whose value is tied to something else: oil prices, currency movements, stock indices. Think of them as financial tools that sort of amplify the market's underlying heartbeat. Curious how they work, why they matter. Let's dive in.
Absolutely. I mean, finance can seem like a maze, right? And derivatives, well, they can feel particularly intimidating with all their mechanics. But that's exactly what we're focusing on today. Our mission is to demystify these essential tools, give you a clear path to understanding them. We're drawing from a dedicated chapter on derivatives, aiming to boil down the core ideas into insights you can actually use.
Exactly. And this deep dive, it's built on a really solid foundation. This chapter lays out the whole landscape. We're talking the definition, the basic concepts driving them, the different types: forwards, futures, options, swaps, also the market structures, and crucially, their purpose. Plus the risks and rewards. We'll even zoom in on equity, currency, commodity derivatives specifically. So yeah, get ready to unlock a deeper understanding of this fascinating and vital part of finance.
Okay, let's start with the absolute basics. What is a derivative? Well, in essence, it's a contract or a product. Its value comes from or is derived from the performance of an underlying asset. And that asset could be almost anything: tangible stuff like gold, oil, wheat, or financial things like stocks and bonds. It's kind of like a movie based on a book. Its success really depends on that original source.
Okay, so its fate is tied to something else. Got it. Now, our source gives us some specific definitions, especially for the Indian regulatory scene. Can you shed some light there?
Sure. So the Securities Contracts Regulation Act, 1956, the SCRA, it gives a pretty comprehensive definition. It covers any security that's derived from debt, shares, loans, risk instruments, even these things called contracts for differences. And critically, it also includes any contract where the value changes based on prices or indices of underlying securities. So under this act, derivatives are actually classified as securities. They fall under that whole SCRA framework.
Right, so legally in India, they're in the same bucket as stocks and bonds. That's important. And there's another key definition, too, from the Reserve Bank of India.
Yeah, the RBI Act 1934 also defines them. Their angle is more about an instrument settled in the future, whose value changes because of shifts in interest rates, FX rates, credit ratings, security prices, the underlying, a mix of these. The RBI definition even gives examples like interest rate swaps, forward rate agreements, options on currencies, that kind of thing.
Both definitions really hit home that idea of value from somewhere else and the future settlement aspect. Sounds like this chapter we're using is pretty thorough.
Oh, definitely. The learning objectives listed give us a clear roadmap. We'll start with the basics, then really get into the underlying concepts, explore the different product types, understand the market structure, look at why they even exist, their purpose, analyze the benefits, costs, risks, and then, yeah, focus on equity, currency, and commodity derivatives, markets, products, strategies. It's a full journey designed to give you a really solid grip.
All right, now we know what a derivative is. Let's unpack some of these underlying concepts. First one, the zero-sum game. Sounds intense. What's that mean for derivatives?
Well, it's fascinating, especially with futures contracts. The zero-sum idea comes from the totally opposite views of the people involved. Think about it like this. Someone sells a gold futures contract. They're betting the price will drop, right? If it does, they profit. But on the other side of that exact trade is a buyer who thinks the price will go up. They profit if they're right.
So a direct clash of expectations on price direction.
Exactly. When the contract matures, the market price of gold is the same for both, which means one person's profit perfectly matches the other person's loss. If you just look at those two, the total gain and loss is zero. It's basically a direct transfer, assuming no costs. Every trade has a winner and a loser.
Okay, makes sense in theory, but the source mentions conditions for that to be perfectly true.
Yeah, that perfect zero-sum outcome really relies on two big assumptions: no taxes and no transaction costs. Obviously, in the real world, you have those, so they nibble away a bit, reducing the net sum slightly.
Got it. Okay, next concept. Settlement mechanism. How do these contracts actually get finalized or, settled?
Right, there are two main ways. The first, and maybe historically more common, is cash settlement. Here, when the contract expires or gets exercised, no actual asset changes hands. Instead, they just settle the difference in price. So if you had a stock contract and the price ends up different from the contract price, one party just pays the other the difference in cash.
Seems efficient. But you mentioned physical settlement is growing in India.
That's right. Physical settlement means the actual underlying asset gets delivered when the contract expires. So if you had a futures contract for, say, 100 shares of a stock, the seller actually delivers those shares to the buyer. The buyer pays the agreed price. And SEBI, the regulator in India, has been pushing for this. They've mandated a phase shift towards physical settlement for all stock derivatives that used to be cash settled. It's a big shift aimed at boosting market integrity, reducing manipulation potential.
Interesting. So the actual stuff changes hands. Now let's get into margining. Hear this term a lot. What's it really mean for derivatives?
Think of margin as like a security deposit. It's the money or securities that clearing members have to put up before they can even trade derivatives. The whole point is to make sure that if someone loses money on their open positions, there's cash readily available to cover those losses quickly. Unlike forwards where it's all about credit risk, this margining in exchange-traded derivatives is a massive risk management tool.
So it's like a guarantee you can cover potential losses.
Yeah.
And there are different types of margins.
Yep. First is the initial margin. That's the amount blocked right at the start, assuming you hold the position till expiry. It actually has two parts. Span margins and ELM, which stands for extreme loss margin, both have to be deposited before you trade. The idea is it should cover losses in like 99% of scenarios. The system is constantly checked, so if your position moves against you, you might get a margin call to top up your account. It stops huge losses piling up.
99% sounds pretty robust. And I guess the riskier the asset, the higher the margin.
Exactly. More volatility means bigger potential price swings, so more risk. To cover that higher risk, the initial margin needs to be bigger. Simple as that. The source mentions S-Man, that's Standard Portfolio Analysis of Risk. It's this sophisticated software from the Chicago Mercantile Exchange that exchanges use globally to figure out these complex margin needs.
So SPAN is the brain behind calculating the collateral needed. And what about the other type mentioned? Premium margin. Who pays that?
Premium margin is just for options trading. It's paid by the buyers of options. It's basically the option premium, the price of the option, times the quantity they bought. Think of the premium as the fee you pay for the right to buy or sell later. This margin just covers that upfront cost, like paying for an insurance policy almost.
Okay. Initial margin is the general safety net. Premium margin is the options entry fee. Last underlying concept here. Open interest. Sounds like it changes a lot. What does it track?
Open interest is super important, especially for futures and options. It's the total number of contracts that are still outstanding. They haven't been settled or closed out yet. And how it changes is key. Open interest only goes up when a brand new buyer and a brand new seller come together and create a totally new contract. It goes down when an existing buyer and seller close their positions, basically canceling out a contract.
So it's not the same as trading volume for the day.
Exactly. That's a common mix-up. Volume is just the total number of contracts traded in a period. Open interest is a snapshot. How many contracts are still live right now? It measures market activity, sure, but it can also hint at money flow. Rising open interest often means new money is coming in. Falling suggests money's leaving as people close out. So if you're trying to read the market, rising open interest might signal growing conviction about a price move, perhaps.
That's a really useful distinction. Open interest, outstanding contracts, potential money flow sign, volume contracts traded. Got it. Okay, now we've got those concepts down. Let's move to the different types of derivative products, starting with forwards.
Right. A forward contract is pretty straightforward. It's a direct custom agreement between two parties. They agree to buy or sell an asset at a specific future date at a price they fix today. You see forwards in commodities, foreign exchange, equities, interest rates, all sorts of markets.
The source used that gold example, buying from a goldsmith spot versus forward. Can you walk through that again? Make it really clear.
Sure. Imagine today, March 9th. Gold is $30,425 for 10 grams right now. Buy it, take it, that's a spot trade. Now, same day, you agree with the goldsmith that you'll buy 10 grams in 1 month. He quotes you $30,450 for delivery then. You both agree. No money, no gold changes hands today. A month later, you pay the $30,450, get the gold. That's the forward contract. Both of you have to go through with it no matter what the market price is then. You're long forward, committed to buy. He's short forward, obligated to sell.
Okay, so the key is it's a direct bilateral deal, obligation for both. And because it's private, the terms can be flexible.
Exactly. Forwards are over-the-counter OTC. Happens directly between the two parties. Price, quantity, quality, delivery details, all negotiated. You can even change it later if you both agree. That custom nature is a big feature. The main reason people do it is to lock in a future price. Get rid of price risk. Certainty.
Sounds good in theory, but the source points out some major limitations. What are the downsides?
Well, one big one is liquidity risk. Because they're tailor-made, they aren't standardized or traded on exchanges. That makes it hard for anyone else to jump into that specific contract, or for you to easily find someone to take over your side if you need to get out early. You can't just easily sell your position.
Hmm. So getting out might be tricky if things change. What's another major risk?
Counterparty risk, also called default risk or credit risk. This is huge. It's the risk that the other guy just won't fulfill their side of the bargain. The source used a rice example. Buyer and seller agree on a future price. If the market price of rice shoots up by delivery day, the seller might be tempted to just not sell at the low agreed price. Or if the price crashes, the buyer might rather buy cheap on the market than honor the contract. It all hinges on the other party's reliability, their creditworthiness. There's no central guarantor like an exchange.
Right, it's all based on trust between those two entities. And I guess other practical issues too.
Yeah, things like lack of transparency, because it's all private. And settlement can sometimes be messy, having to sort it out directly without exchange processes.
So forwards give you customization but bring risks around liquidity and counterparty reliability. Now the next type, futures. Sounds like these evolved partly to fix those forward problems.
Exactly right. Futures were basically the innovation to get around those exact limitations of forwards. A futures contract is also an agreement to buy or sell a fixed amount of something at a future date, an agreed price. But the massive difference is it's done through a regulated, organized exchange. Think of futures as standardized forwards traded publicly.
So the exchange acts like an intermediary, a guarantor.
Precisely. The exchange, via its clearinghouse, becomes the central counterparty to both the buyer and the seller. This massively reduces counterparty risk. You're not relying on the person you traded with anymore. The clearing corporation, backed by the exchange, guarantees the trade settles. Much more secure.
And that sounds way better for default risk. What other features make futures different from forwards?
Well, like we said, it's through the exchange, a central, transparent trading platform. This helps with price discovery, lots of buyers and sellers interacting. Crucially, both sides, the buyer, long, and seller, short, have to deposit and maintain margin, that collateral we talked about. And the exchange standardizes pretty much everything except the price. Quality, quantity, delivery dates, procedures, all set.
So you know exactly what you're trading, just not the final market price.
Yeah.
Okay, moving on. Options. These are really interesting, the whole right but not an obligation thing. Can you explain?
Absolutely. An option gives the buyer the right, but crucially not the obligation to either buy or sell the underlying asset. They get this right at a specific price, the strike price, on or before a specific date, the expiration date. To get this right, the buyer pays a fee, called the premium, to the seller. Two main types. A call option is the right to buy. A put option is the right to sell.
So the buyer holds the cards, deciding whether to act. And the seller has to comply if they do.
Perfect summary. The buyer or holder gets to choose. Is it worth it financially at expiration? They decide. The seller or writer is obligated. If the buyer says exercise, the seller has to follow through.
And the source mentions options being in the money, at the money, or out of the money. What do those mean for the option holder?
Yeah, those describe where the strike price sits relative to the current market price of the underlying. For a call option, right to buy, it's in the money, ITM, if the market price is above the strike. You could exercise, buy cheap, sell high for an immediate profit minus premium. It's at the money, ATM, if the market price is right around the strike, no immediate profit there. And out of the money, OTM, if the market price is below the strike. Exercising wouldn't make sense for the buyer right then. And it's basically the opposite logic for put options, right to sell. They're ITM when the market price is below the strike.
Makes sense. So ITM options have immediate value. The source also mentions time value. How does that fit in?
Right. An options premium has two bids, intrinsic value and time value. Intrinsic value is that immediate profit if exercised now, only if ITM. Time value is whatever's left of the premium after accounting for intrinsic value. It reflects the potential for the option to become more valuable later. The more time left until expiry, generally the higher the time value, because there's more chance the price could move favorably for the buyer.
Okay, intrinsic value, now profit if exercised. Time value, potential future profit. Last type to cover. Swaps. These sound a bit more abstract, exchange of specified cash flows. Can you break that down?
Sure. A swap is essentially a private agreement, a contract. Two parties agree to exchange specific cash flows on set dates in the future. The most common are interest rate swaps and currency swaps.
The source used an example of an interest rate swap with a borrower. How does that work practically?
Okay, imagine a company borrowed money at a floating interest rate, maybe tied to treasury bills plus a bit extra, a spread. Their payments change over time. But maybe they'd prefer predictable, fixed payments. They can enter an interest rate swap, usually with a bank or swap dealer. In the swap, the company agrees to pay a fixed interest rate to the dealer on a certain amount, the notional amount. In return, the dealer pays the company based on that floating T-bill rate plus the spread.
So they're basically trading their variable payment for a fixed one to get cost certainty.
Precisely. The notional principal amount is just used for calculation. It's not actually exchanged. Only the interest payments based on it are swapped. The company uses the floating payment received from the dealer to cover its original floating loan payment, the net effect. Their actual outflow becomes the fixed rate they pay the dealer. They've effectively swapped floating debt for fixed debt.
That really clarifies how swaps manage financial obligations. And even though they're OTC, there's some industry oversight.
Yeah, while they're typically OTC and custom, they usually operate under rules and standards set by swap dealer associations. In India, FIMDIA, the Fixed Income Money Market and Derivatives Association of India, is key. It's made up of banks, institutions, dealers. They liaise with regulators, work on market development training, standard practices, documentation, bring some order to the OTC swap world.
So even in private derivatives, there's a push for standardization and some self-regulation. Okay, now we've done the types. Let's look at the structure of derivative markets. How are they organized?
Well, these markets basically form when people needing to manage price risk come together. In India, you've got derivatives on indices, stocks, interest rates, commodities, quite a range. Plus, those OTC forward markets, especially for agricultural goods, and the swap markets for interest rates we just mentioned.
And again, the source draws that line between OTC and exchange-traded. Quick recap on the differences for derivatives trading.
Sure. OTC derivatives. Negotiated directly between two parties, settled directly, custom terms. Non-standard, relies on trust between institutions. Exchange-traded derivatives. Standardized contracts, terms set by the exchange, settled through a central clearinghouse. Margins are held by the clearinghouse, which allows for anonymous trading. You don't need to worry about who's on the other side because the exchange guarantees it. Generally, forwards are OTC, futures are exchange-traded. That's the main split.
That anonymity from the clearinghouse seems like a big plus for encouraging trading and reducing counterparty worries. Okay, let's shift gears. The fundamental purpose of derivatives. Why do people even use these things?
Right. There are three main reasons, three crucial purposes: hedging, speculation, and arbitrage.
Hedging sounds like protection. How do derivatives shield against risk?
Exactly. Hedging is using derivatives to protect the value of something you already own in investment, a portfolio, from potentially bad future price moves. The goal is usually to lock in a desired return, or just meet an objective by reducing downside risk. Think of an airline using jet fuel futures to fix fuel costs. Protects them if prices spike, right? Or a farmer using grain futures to lock in a price for their harvest before it's even ready, guarding against falling market prices. It's about offloading risk you don't want.
So reducing uncertainty, managing risk proactively. What about speculation? Sounds more like betting on market moves.
That's pretty much it. Speculation is trading based on your prediction of where the underlying asset's price is going. You don't necessarily own the asset itself. For example, if you think a stock's going up, you might buy call options on it. If you're right and the stock rises enough, you can profit significantly. But, and this is crucial, speculation is risky. If the price goes the wrong way, you lose your investment. For options, that loss is usually capped at the premium paid. For futures, because of margin, losses can be much bigger. You're taking on risk, hoping for reward.
A way to potentially magnify gains and losses without owning the asset. Got it. And finally, arbitrage. The source mentions the law of one price again. How does arbitrage fit in?
Yeah, the law of one price says identical things should cost the same in different markets at the same time, ignoring transaction costs. If a price difference pops up, arbitrageurs jump in. They simultaneously buy where it's cheap and sell where it's expensive, locking in a risk-free profit. This action itself, buying the cheap one, selling the pricey one, pushes the prices back together, eliminating the difference. Derivatives, especially futures and options, are key tools for this. Arbitrageurs use them to exploit temporary mispricings between, say, the spot market and the derivatives market for the same asset. Keeps markets efficient. These price gaps only really exist up to the level of transaction costs: transport, storage, interest, etc. Eventually, at expiry, the derivative price has to match the underlying price.
So arbitrageurs act like market efficiency police, profiting from gaps while closing them. Okay, considering all these uses and types, what about the overall Benefits, costs, and risks of derivatives mentioned.
Okay, benefits first. One, they give people really sophisticated ways to hedge and manage risk thanks to flexible payoff structures. You can really tailor your risk exposure. Two, they can actually boost liquidity in the underlying cash markets and potentially lower overall trading costs, both for the derivatives and the assets themselves. And three, they tend to increase market participation, help information spread faster, and lead to better, more accurate price discovery.
Those sound like pretty solid pluses for the financial system, but we know there are downsides too. What are the key risks highlighted?
Absolutely. Risk-wise, you've got counterparty risk like we discussed with forwards, the risk the other side defaults. Price risk, just the basic risk of losing money if the underlying price moves against you. Liquidity risk, the danger you can't easily get out of a position, maybe in a less traded contract. Legal or regulatory risk issues around contract enforceability or changing rules. And operational risk that covers things like fraud, documentation errors, mistakes in execution or settlement, stuff going wrong in the process.
And it sounds like the source has a strong warning for individuals thinking about trading these.
Yes, very much so. It stresses that derivatives are leveraged. A small price change in the underlying can mean a much bigger percentage gain or loss on the derivative. Because of this, they might not be right for everyone, especially if you have limited money, not much trading experience, or you just can't stomach big risks. The source strongly advises people to really think if derivatives trading fits their situation and goals, and crucially, to read the model risk disclosure document from their broker before they start trading.
That's a really vital point. Leverage cuts both ways. Big potential gains, but big potential losses too. Okay, let's focus now on specific categories: equity, currency, and commodity derivatives. The source says the basic ideas are the same across all.
That's right. Whether the underlying is a stock, equity, an exchange rate, currency, or something like oil or wheat commodity, the core concept is identical. The derivative's value comes from that underlying asset.
Let's start with commodity derivatives. What's their main role in the world of physical goods trading?
Commodity derivatives are absolutely essential for modern commodity trading. They're key tools for managing price risk and also part of many investment strategies. They really help the whole commodity value chain by enabling risk management, reducing or transferring risk, helping discover fair prices, and making transactions more efficient. They let people like farmers, traders, food processors hedge against volatile commodity prices using futures and options. And these contracts are highly standardized. Quantity, quality, delivery, time and place, how price can move, all specified.
The source mentioned a biscuit maker using wheat futures. How does that help manage their business risk?
Right. Imagine a biscuit company knows it needs a certain amount of wheat months from now. They could buy it all today and store it. Or if they worry the price might go up, they can buy wheat futures contracts on an exchange instead. This locks in a price for that future wheat delivery no matter what the spot market price is doing then. Using derivatives like this helps the manufacturer manage their raw material costs and reduces the risk of sudden price hikes hurting their profits.
Clear example of hedging in action. And in India, where do these commodity derivatives trade?
Commodity futures trading in India happens only between members of exchanges approved by SEBI, the regulator. The main national exchanges are MCX, Multi-Commodity Exchange, NCDX, National Commodity and Derivatives Exchange, ISICEX, Indian Commodity Exchange, plus NSE and BSE also offer commodity derivatives now. They trade things broadly classed as bullion, gold, silver, metals, copper, zinc, energy, crude oil, natural gas, and agriculture, wheat, soybeans, etc.
Okay, on to currency derivatives. Here, the underlying is an exchange rate. What's their main purpose?
Primarily, managing currency risk. Currency trading is always in pairs. You buy one, sell another simultaneously. Fluctuating exchange rates create risk, right? Currency derivatives, forwards, futures, swaps, options are the tools used to manage that risk to lessen the potential negative impact of currency moves.
The source mentions currency futures and currency options. Briefly, how do those help manage currency exposure?
Okay, a currency future, or FX future, locks you into exchanging one currency for another at a set future date at a fixed exchange rate decided today. Really useful for businesses with future foreign currency income or payments who want to eliminate exchange rate uncertainty now. Currency options give the buyer the right, not obligation, to buy or sell a currency at a specific rate during a set period. You pay a premium for this, right? Good if you want protection against bad moves, but still want to benefit if rates move your way.
And which currency pairs are commonly traded as derivatives in India?
The main ones are against the Indian rupee, INR, the US dollar, USD, Euro, UR, British pound, GBP, and Japanese yen, JPY. Plus, you also have cross-currency futures and options like EUR USD, GBP USD, USD JPY available on the major exchanges currency segments.
So a good spread of major global currencies. Now, the final section here covers derivative markets, products, and strategies. It kicks off talking about their introduction in India. Sounds like quite a growth story.
Oh, absolutely. Derivatives started trading in India back in June 2000. Since then, the volume and turnover have just exploded. Seriously, India's equity derivative markets are now among the largest in the world. Shows how important and mature they've become here.
The discussion then gets into pricing a futures contract and the carry cost principle. Sounds fundamental for understanding futures prices.
Yeah, the carry cost principle is key. Let's use an example. Stocks at 100 spot today. A futures contract for delivery in, say, 20 days might be trading at 120, that euro difference. It mostly reflects the cost of carrying or holding that stock for 20 days. The biggest part is usually the interest cost on the money tied up. So generally, the futures price, F, equals the spot price, S, plus these carry costs.
So the futures price isn't just random, it's economically linked to the spot price via these holding costs. And the law of one price comes up again.
Yep, it's all rooted in that. If the futures price got way out of line with spot plus carry costs, it creates a risk-free arbitrage chance. Like if futures were way too high, traders could buy spot, sell futures, hold the stock, deliver, and lock in a guaranteed profit. That arbitrage activity forces prices back towards their theoretical link. The difference between spot and futures after costs is called the basis.
And this basis tends to shrink as the futures contract gets closer to settlement.
Exactly. On settlement day, spot and futures prices must converge, become basically identical. Why? Because the cost to carry until settlement is now zero. Settlement is today. This spot-future convergence is fundamental to how these markets work.
The source revisits spot-future arbitrage, showing how bigger than justified differences can be exploited. Used a stock XYZ example. Can you quickly outline that?
Sure. On March 3rd, 2017, XYZ stock was 3,984 cash. The March 30th future was 4,032. That 48 difference might have been more than the carry cost justified for that period. So an arbitrager could buy the stock at 3,984, simultaneously sell the future at 4,032. On settlement day, the prices converge. The arbitrager makes 48 per share profit minus transaction costs, risk-free. The source even calculated that as over 16% annualized profit in that specific case, showing the potential when mispricings happen.
That's a great real-world example of arbitrage in action. Finally, this part touches on option payoffs, highlighting their asymmetric nature. What does asymmetric mean for options?
Asymmetric payoff just means the potential gains and losses aren't balanced for buyers and sellers. If you buy an option, go long, your maximum loss is fixed. It's just the premium you paid. Can't lose more than that. But your potential profit, theoretically unlimited for a call option if the price keeps rising, or substantial for a put if the price falls to zero. Now, if you sell or write an option, go short, your maximum profit is capped. It's just the premium you received up front. But your potential loss could be theoretically unlimited for calls or very large for puts if the price moves sharply against you and the buyer exercises. The source also briefly notes futures and options are great for hedging too, showing their flexibility and different risk-reward profiles.
So buying an option, limited downside to premium, potentially large upside. Selling an option, limited upside to premium, potentially large downside. That asymmetry is really key.
Exactly. It creates totally different risk-reward setups, fitting different strategies and market views. Lets people fine-tune their risk.
Well, this has been a really thorough deep dive into derivatives. We've covered so much ground. From what they are, the core mechanics, the different types, where they trade, why they exist, the risks, the benefits, even basic pricing ideas.
Yeah, indeed. We've seen that derivatives, though maybe seeming complex at first, are fundamentally tools tied to an underlying asset's value. We've explored how forwards, futures, options, swaps all serve different important roles, managing risk via hedging, trying to profit via speculation, or keeping markets efficient via arbitrage. Getting a handle on these mechanics is just essential if you want to navigate financial markets more effectively. Hopefully today's chat gave you that solid foundation.
Absolutely. And for you listening, if you want to explore more, here's something to chew on. With global markets so interconnected, how might some unexpected event halfway across the world ripple through and affect the pricing and risk of these derivatives we've discussed? Or, when you think about this, as markets get easier for individuals to access, what are the considerations around using powerful, potentially complex tools like derivatives? Which part today really grabbed your interest? Was it options pricing, commodity futures for risk management, how swaps work in finance. We'd really encourage you to dig deeper into whatever sparked your curiosity. Find more resources, keep the discussion going. The world of derivatives is always changing, and honestly, continuous learning is the only way to stay informed and make smart decisions.